Do you want to know how to invest in cryptocurrencies? Here is the ultimate beginner's guide you need to know. Stick till the end of today's conversation. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. And if you are doing great as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to have a conversation about investing in cryptocurrencies, and I'm giving you here the ultimate beginner's guide. Now, first thing you need to do is that learn how to invest in crypto. By the way, folks, I need to give you a disclaimer before continuing here. We're not a financial institution, so everything we are providing you in this show is educational material. So do not take this information as professional investment advice. Need to cover my butt here. All right, so you need to learn how to invest in cryptocurrencies. There are a lot of ways you can do this. You can actually go on the internet. You can actually sign up with a brokerage firm like Robinhood. It's very important to know exactly what you're getting yourself into. Why? There are three major good reasons to invest in crypto. First, you want to hedge your net worth against the fall of the dollar, for example. Second, because you support the social vision behind cryptocurrencies that are free and hard money for the whole world. And third, because you understand and like the technology behind it. So you cannot invest in crypto without knowing exactly what's driving you in the first place. And once you know what's driving you, which of the three reasons I just mentioned is driving you, you have to educate yourself. There are tons of videos on the internet. There are tons like this one, for example. There are articles, there are books that talk about crypto investment. There are even forums where you have to you can go and educate yourself. One thing you have to remember, though, folks, there are also very bad reasons to invest in cryptocurrencies. Many people fall victim to the hype surrounding every cryptocurrency bubble. Remember, there is always somebody captured by the fear of missing out, FOMO, buying massively in at the peak of the bubble just in the hope to make quick money while not understanding cryptocurrencies at all. So that's the bad reason. Don't do this. You want to learn before you invest. Early stage investors in Bitcoin and Ethereum made millions of dollars in pure profits. There's no question about it, right? So if you see the graph that we're currently showing you on the screen right now, you will know exactly what I mean. So we're showing here, like in this graph comes from CoinDesk, and you can see the evolution of a Bitcoin, the BTC, from 2014 all the way to 2020, and you saw the huge peak we had 2 years ago in 2018. And then you have the second graph also coming from Bitcoin, and this is basically, I'm showing you here this year. So in 2020, you can see that the gyrations, if you will, of the Bitcoin from January all the way to October. Again, the Bitcoin is still up. The reason why I'm showing you those two charts is to make sure that you understand you got to be okay with taking calculated risks. So because of volatility of crypto, you have to understand that they're not a normal investment. Plus, there is always the risk that your country may outlaw cryptocurrency trading and exchange. So if that's the case, then you should make your peace with not liquidating your crypto assets. So the important takeaway here is to only risk as much money as you can afford. You want to allocate only a small percentage, folks. Do not just bet the whole bank. Please allocate only a small percentage of your portfolio to cryptocurrencies. You got to decide, think of it as play money. You have to decide in advance how much of your portfolio you want to allocate to crypto. With recent advances, particularly in the price of Bitcoin, it can be difficult to make a rational decision. So all investing is ruled by a combination of greed and fear. But please, you have to be very careful that no matter what, you have to understand that cryptocurrencies should occupy only a very small part of your portfolio. Exactly how much is completely up to you. I can't tell you put 5%, put 10%, put 20%, put 1%. You should be wary of investing more than 10% or even 5%, especially if you are a risk-averse investor. you want to understand that the most basic reality is that cryptocurrency is not even an investment. Much like investing in gold and silver, it doesn't pay interest or dividends. So to the degree that cryptocurrency will be a good investment, all depends entirely upon its price increasing significantly. So it's all about speculation if you think about it. So cryptocurrencies traditionally were not designed to be investments. They are mediums of exchange. So they've widely been seen as an alternative to sovereign currencies like the dollar, the euro, and the yen. So it's been thought that the cryptocurrencies will ultimately represent a more efficient means of commerce, particularly on the web. And that's because the value of crypto is determined strictly by the market and not by manipulation as sovereign currencies tend to be. But at least up to this point, cryptocurrencies have not satisfactorily filled the role of being a medium of exchange. So if you really think about it, only a very limited number of merchants accept them. So most trading activities nowadays are taking place between individuals. As I've been talking to you about the advantages of cryptocurrencies, and I've been talking to you about Bitcoin, please remember that there are other coins. Bitcoin is not the only one. You have a variety of coins, and so you have to choose your cryptocurrency properly. We're showing you right now, and this is a chart that we got from coinmarketcap.com, and this via blockgeeks.com. And we're showing you the variety of cryptocurrencies you have on the market. So you have, of course, Bitcoin has the lion's shares of the market with $110 billion. And then you have Ethereum, 20 billion. You have XRP, 18 billion. Bitcoin Cash, 8 billion. EOS, 4.8 billion. Stellar, 4.4 billion. Litecoin, 3 billion. Cardano, 1.8 billion. And Tether, 1.7 billion, 1.8 billion, if you will. And you can see also that there is a column called the circulating supply, and you can see the available supply right now, and you can also see the change in 24 hours. So you can see that right now, as of the date of this show, the Bitcoin Cash has made a 10% increase in 24 hours. Remember, again, Bitcoin and other cryptocurrencies are not traditional investment. They don't pay dividends or interest. You're only making money on the appreciation, on the increase of the cryptocurrency's price. So that's very important. Now, hands down, as of today, Bitcoin is still the dominant crypto out there. And because of the dominant position, your cryptocurrency position should be mainly in Bitcoin as of today, because other cryptocurrencies should occupy a much smaller position in your portfolio. So, and if Bitcoin is as the bellwether of cryptocurrency is a speculation, any other cryptocurrency you hold should be seen as even more speculative. So this is kind of important. I just wanted to mention that. And one other thing that you have to think about here is that if you want to have more info, please go to the website called coinmarketcap.com, and it's a useful tool to have in your hand, especially if you're trying to follow the cryptocurrency market on a daily basis. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We are also having a conversation here around how to invest in cryptocurrencies. And I have have a conversation with you around the fact that there are other coins besides Bitcoin. You have to be okay with taking calculated risks, and you have to learn how to invest in cryptocurrencies. Number 4, you need to think about the utility that the coin is bringing into the system. Anytime we talk about cryptocurrencies, if you want to invest in a cryptocurrency, you need to think about the utility, the usefulness of the coin. What kind of utility, what kind of helpfulness is the coin bringing into the system? So the first thing that you need to do is to read the white papers of the sponsors. So now you understand that, reading PDFs may not be the most exciting of things. However, you absolutely, and I repeat, you absolutely have to put in the work beforehand before you reap any sort of benefits. So first, reading the white paper itself will give you two tremendous benefits. Number one, you will be more knowledgeable about the coin itself, and you can learn about the utility that it is bringing into the ecosystem. Number two, a poorly written white paper is often a good sign of knowing whether a project is worth investing in or not. So if the team itself can simply explain the true utility of their token, then it is probably not worth investing into. So that's very important. So one thing you have to pay attention to is that by reading the white paper, so while you're reading the white paper, you want to check two things. So the value that the project is bringing in. So you want to see that the coin is bringing any real utility into the system. Let me give you an example. Take Ethereum. There is a reason why it took off so fast if you think about it. Think of the sheer value that it was bringing into the ecosystem. For the first time, developers around the world had a platform that they could use to build their own dApps on a blockchain. Along with that, keep in mind the issues that crypto world is desperately looking to solve, mainly the privacy, the scalability, and the interoperability. So a good way to go about your investment is to find the projects which are specifically working on solving the aforementioned problems. The second element here is that, does the project need tokens? So how do you make sure that you're getting good quality tokens? You inspect the projects and ask yourself the following questions. Does this project need to be on the blockchain? That's number one. And the second question is, does this project need to have tokens? So if the answer for any of those happens to be a no, then those projects don't need a token, and those projects are doing an ICO simply to raise money. There is a way to find out the true utility of the token. So to find the true utility of a token, according to one of the celebrities in the crypto world, William Mogayer, he actually has crafted an article and a chart that shows how you can assess, how you can evaluate the utility of a token. There are three things in his triangle. So you have the role, the features, and the purpose. We're showing this right now on the screen. So these three are locked up in a triangle and they look like this. So you have the role on top, you have the features on the left side, and the purpose on the right side, and token usage and value variables. So each token role has its own set of features and purpose which are detailed in the white paper. And I'm showing you right now also another chart which basically came from William Mogayer, and this is a guide to crypto tokens usage and value. So you can see here the role, you have the rights, value, exchange, toll, function, currency, and earnings. I will speak about that later on. And the purpose here is the bootstrapping engagement, economy creation, skin in the game, enriching user experience, frictionless transactions, and distributing benefits. And the features are also very interesting. Here you have they range from product usage to profit sharing, benefits sharing, and inflation benefits. Now let's really kind of examine each of the roles that a token can take up. Let's do this really quickly. So what's the right? By taking possession of a particular token, the holder gets a certain amount of rights within the ecosystem. For example, by having DAO coins in your possession, you could have had voting rights inside the DAO to decide which projects get funding and which don't. The value exchange. The tokens create an internal economic system within the confines of the project itself. So the tokens can help the buyers and sellers trade value within the ecosystem. So this helps people gain rewards upon completion of particular tasks. You also have toll. So a cryptocurrency can also act as a toll gateway in order for you to use certain functionalities of a particular system. What's the function? The token can also enable the holders to enrich the user experience inside the confines of the particular environment. And the currency. So it can be used as a currency. So the cryptocurrency can be used as a store of value that can be used to conduct transactions both inside and outside the given ecosystem. We're also talking about earnings. So a crypto helps in a fair distribution of profits of or other related financial benefits among investors in a particular project. So how does this all help in token utility? If you want to, let's say you're an investor, right? So you're thinking about investing in a token, for example. If you want to maximize the amount of utility that your token can provide, then you need to take off more than one of these properties. You got to have at least 3 or 4. The more properties you can take off, the more utility and value your token brings into the ecosystem. So if the role of your tokens cannot be clearly explained, or if it doesn't really take off more than one of the roles given above, then your token, guess what, does not have any utility and you can't do without it. So you need to understand the concept of token velocity, and because this would allow you not to take useless tokens with little or no utility. So token velocity really indicates how much people respect the value of that particular token. So if people hold on to a token, then it has low velocity. However, if people quickly sell that token for BTC, ETH, or fiat, then that token has high velocity. So if you were to define token velocity in strictly mathematical terms, then it will look like this. What we put this on the screen right now. So token velocity equals what? Token transactional volume divided by average network value. And if we were to flip the formula, then average network value equal total transactional volume divided by token velocity. If you really look at this, you are forced to reckon with two conclusions. So the more the token velocity, the less the average network value, and the more the transactional volume, the more the token velocity. So this is the reason why you should work for a project whose tokens actually have some utility and gives their users a reason to hold on to them. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We're also having a conversation around how to invest in cryptocurrencies. And if you love the content's clarity and quality so far, please consider subscribing to our channel and turn on the notification bell, and like this content, share, and comment below. I want to talk to you about scams. You want to look out for obvious signs of scam. If you want to be a crypto investor, it's very important. And there are several ways you can find out whether or not this is the real deal or this is just a bunch of scammers, a bunch of crooks. You got to think about the team. Look at the team. So it really goes without saying that the success of a project is directly related to the credibility of the team, right? Let me put it this way. If you are investing your money into a company, would you want to know that the company is in good hands or not, and that your money is going to be appreciated considerably? It's the same thing when it comes to an ICO. If you want to, so first you want to search for the names of the team members on Google. Most of the time they should have a LinkedIn profile. So you want to do a quick search and learn more about the team members. You want to ask yourself the following questions. Have they been involved in the past in any successful ICO venture? Have they been involved in a well-reputed company? I'm talking here Google, Facebook, Deloitte, KPMG, McKinsey. Have they been recommended or endorsed by well-known people? What you're trying to hear, you're looking for authority here. You're looking for credit worthiness. You're looking for trustworthiness here. Secondly, you should search for the images of the team members on Google. The reason for this is again twofold. First, you want to make sure that you're not getting catfished. In other words, they're not putting up photos of random celebrities or stock photos on their website. Secondly, the person may be using the same photo on different websites and projects. So it will give you a great idea about whether the person actually exists or not. And if they do, how involved they are. So the team is very important. Number 2, try to avoid a pyramid scheme. Try to avoid anything that relates to a pyramid scheme. So what is a pyramid scheme? This is also called a pyramid scams. This is a business model that recruits members via a promise of payments or services for enrolling others into the scheme, rather than supplying investments or sale of products or services. So as recruiting multiplies, recruiting becomes quickly impossible and most members are unable to profit. As such, pyramid schemes are unsustainable and often illegal. At least in the United States, they are illegal. So an ICO that promises guaranteed returns on their investment, guess what? It's a scam. So any crypto investor worth their salt will tell you that there are no guarantees in the crypto world. I already explained that to you. Let's take one of the infamous examples. You see Bitcoin, we're showing you right now on the screen, Bitcoin. And let's take a look at what they promised. And you can see that, you have here, they were promising you 60%, 10% per month, 50%, 40%, 30%, 20%, and 10%. And guess what? It was just a scam. And you can see on the second chart here that the token actually lost value. It lost value really quickly, very quickly. As of January, lost value very quickly. January 2018, they lost value. So that's something you have to be very careful about. When it comes to buying cryptocurrencies, you want to think about the two types of exchanges. Some of the largest, and this is very important because you need to be very careful, because one of the disadvantages with buying cryptocurrencies is that you cannot get them in all of the usual financial places. Banks do not offer them, and neither do investment brokerage firms, except Robinhood. So for the most part, you'll be limited to buying, holding, and selling cryptocurrencies on dedicated cryptocurrency exchanges. And some of the largest include CoinDesk. This is probably the most popular cryptocurrency exchange and the one that seems to be the most, I would say, the most commonly quoted in the financial news media. You have, besides CoinDesk, you have Binance, Terexa, Coinbase, Kraken, and you want to think of these platforms as brokerage firms specifically designed for cryptocurrencies. And each offers trading in the most popular cryptos, and of course you should expect to pay a fee for both buying and selling. There is so you can buy, the great thing here is that, as I said earlier, by Robinhood, you can buy cryptos through Robinhood. You can also buy stocks, options, ETFs, commission free. This is kind of cool. All right. Now, the thing here is that the exchange serves as one of the most critical functions in the crypto ecosystem. It basically acts as a portal between the fiat world and the crypto world. So there are usually two types of exchanges: fiat to crypto and crypto to crypto. So fiat to crypto exchanges helps you buy cryptocurrencies in exchange for fiat money. And by fiat money, I'm talking about dollar, yen, euro, those traditional currencies. So Coinbase is a perfect example of this kind of exchange. So Coinbase helps you buy BTC, BCH, LTC, and Ethereum in exchange for fiat currency. So besides fiat to crypto, you also have crypto to crypto. So these exchanges help you exchange certain cryptos like BTC, Bitcoin, Ethereum, BCH, etc. for other cryptocurrencies. So Binance is a fine example of a crypto to crypto exchange. So while they do offer pretty valuable services, the problem is that they are all centralized, folks, which makes them vulnerable. This is an extremely risky proposition when you consider the sheer amount of money that these exchanges deal with each and every single day. So one thing you have to be very careful here is that when it comes to buying crypto from these exchanges themselves, it's really not that complicated. So first, you just have to open an account at the exchange, whether it is Coinbase, Binance, Terexa, CoinDesk, or Kraken. You then verify your identity. This is required due to the AML rules in most jurisdictions. AML stands for anti-money laundering. So you want to fund your account with dollar or euro or whatever paper money you use. On some exchanges, the thing is that you don't need to fund your account. You can trade directly with other users, and this could be good also. And you see this, for example, in Germany, so bitcoin.de. So the question What exchange to use depends mostly on where you live. It's always better to use an exchange physically close to you. If it is located in the same jurisdiction as you have the best chances to get money legally back if some bad things happen. If no exchange is located in your jurisdiction, you want to use exchanges based in stable countries with a good legal system. Very important. And also, if you, in deciding which exchange to use, you have to think about the coins you want to buy and sell. So if you want to acquire large sums of Bitcoins fastly, you need to use one of the major exchanges which provide enough liquidity. If you only want to buy small amounts of coins, and if you're not in a hurry, you can try to buy them on small exchanges. And the thing here is that if your order gets filled, you most likely will get better prices than on big exchanges. So once you learn to invest, and once you know which exchange you want to buy your crypto on, the question is there a good time to buy? And this is an answer that has been given time and again. There is no general rule when to buy cryptocurrencies. Usually it's not a good idea to buy in at the peak of a bubble, and usually it's also not a good idea to buy when it is crashing. So this is totally up to you. The best time might be when the price is stable at a relatively low level. When it comes to trading, it's the same when it comes to trading crypto or trading stocks or bonds for that matter. You got to decide when an asset is in a bubble mode and when it reached the bottom after falling. What is easy to say in retrospective is a hard question in the present. So this is something you have to make a decision on your own, and you can never answer this question with absolute certainty, right? So this is important. Now, sometimes a coin might start to raise, and after it passes the mark where everybody thinks this must be the peak of a bubble, the real rally just begins. So this is kind of important to think about. Don't try to time the market, but you have to use some tools. You can use technical tools. You can use, I personally use Fibonacci. I use the regular tools that you can use in other markets. Fibonacci, you can use the average line, the MACD, for example. You can use the average price. You can also use the parabolic SAR, for example. So there are several tools you can use. You can also read to sort of educate yourself. So second, you want to take some time to watch. Don't buy in because there was a dip. There might be another. And don't buy in because you fear that it will explode tomorrow. You want to get yourself informed. You want to educate yourself. And one thing that's very important is that once you're sure about a certain trend, get in. Again, as I said earlier, use money you can afford to lose, because Bitcoin or cryptocurrency investment in general are pretty much speculative. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. We're also having a conversation here around how to invest in cryptocurrencies, and I just want to tell you that the next thing you need to do is to learn how to store cryptocurrencies. So when it comes to cryptocurrency storing, you have to understand that once you bought your cryptos, you need to store them. You need to keep them off the exchange. There is absolutely no way that you should keep your coins in an exchange. There is a long history of hacks and bankruptcies in cryptocurrency markets, so you got to be very careful. Now, when it comes to storing, how do you do that? Now, cryptocurrency is typically stored in a cryptocurrency wallet. This is a complex topic, folks, particularly since there are so many wallets available. But let me try to boil it down to the basic facts. So what is a wallet? A crypto wallet is a software program that stores the private and public keys that connect you to the blockchain where your cryptocurrencies exist. Wallets don't actually store your cryptocurrency, but they enable you to access it on the blockchain with your public key, that is your cryptocurrency address that the other party in the transaction sees, and private key known only to you. So you must have both in order to complete a transaction, your public key and a private key. So they're called keys because they are used to unlock your cryptocurrency on the blockchain. So in addition to enabling you to access, send, and receive cryptocurrency, a digital wallet also provides a record of transactions that are stored on the blockchain, as well as your current balance. So there are several types of digital wallets, folks. You have desktop wallets, online wallets, mobile wallets, and hardware wallets. So desktop wallets are installed on your personal computer. So since storage is on your own computer, the information is safer than with online wallets. With online wallets, you have your info on the cloud and they can be accessed from any computer. So they are more convenient to use, but your private key is stored online and controlled by a third party, which might make this less secure. You also have mobile wallets. So this type of wallet is an app on your smart device. So they have the advantage of being able to be used to make purchases where various cryptocurrencies are accepted. And you also have hardware wallets. So these wallets store your private key on a hardware device, such as a USB device. So they're more secure because the private key isn't stored on the internet, where it could be accessed by unauthorized parties, right? So they also let you access your cryptocurrency from multiple devices. The question is, which digital wallet you choose will depend on your own desire for a balance between security and convenience. Some cryptocurrency exchanges also offer digital wallets for your cryptos. Let's also talk about now hot wallets versus cold wallets. You hear these terms thrown around in discussions about cryptocurrencies, and let's understand the basic distinction between the two with a real world example. Let's say that, hot storage. Hot storage is like the wallet that you carry around in your pocket. The cold storage is basically something similar to your savings bank account. So you want to keep this distinction in mind as we move forward. So hot wallet storage. So hot storage in simple terms is when you keep your cryptocurrencies in a device that is directly connected to the internet. This connection is what makes the device hot. So you should think of exchange wallets, desktop clients, and mobile wallets as a hot wallet. It's easy to access funds on a hot wallet, and if you live somewhere that accepts cryptos for micropayments, there is nothing wrong with using one for day-to-day spending. So you want to think of it like a fiat, government-issued currency. You might walk around with a portion of your wealth in a wallet for convenience, but the majority you keep secured away. So your hot wallet should behave in the same way as a real-world wallet. What are the pros of hot storage? You have quick access to funds, a wide number of options, and support for different devices. It is user-friendly, so you can make sending and receiving simple. And the disadvantages of hot storage is that you are exposed to cybercrime because sophisticated hackers, ransomware, and other malicious actors are a constant threat. Damaging the device could destroy the wallet, and you could still lose, damage, or have stolen the restoration details. One thing you have to really be aware of is that there are different kinds of hot storage wallets that you can use. So you have online wallets, aka cloud wallets, mobile wallets, desktop wallets, multi-sig wallets. So I'm kind of giving you here the different types of wallets you may have, because the whole crypto space has been gaining a lot of value recently, and where there is value, guess what? Crime is never far behind. So recent ransomware attacks and previous compromises of large exchanges should be sufficient beacons to newcomers. Besides the hot wallets, let's talk about cold wallets or cold storage. So when you keep your cryptocurrency in a device that is completely offline, it's called cold storage. So for those seeking the most secure form of storage, cold wallets are the way to go if you really think about it, because they are suitable for long-term holders who don't require access to their coins for months or years at a time. They're not without their own set of risks though, but if you follow the instructions correctly and take every precaution possible, these are greatly minimized. So given the amount of attention that cryptocurrency has been receiving over the last few years, it has unfortunately piqued the interest of attackers. So, what are the pros of cold storage? It's a great place to hold large amounts of coin for a long period of time. It provides a safety net against hackers and people with malicious intent, since it is completely offline. It's not on the internet. And the disadvantages of cold storage are that it is still susceptible to external damage, theft, and general human carelessness. It is not ideal for quick and daily transactions, and setting it up can be a little intimidating for beginners. So now that we have seen both the pros and cons, we're going to take a look at some cold storage wallets that you can use to store your your coins. So hardware wallets. So you have wallets such as Ledger Nano X, you have Treasure, and you have KeepKey. And you also have paper wallets. So a paper wallet, to keep it simple, paper wallets are an offline cold storage method of saving cryptocurrency. So it includes printing out your public and private keys in a piece of paper, which you can then store and save in a secure place. So the keys are printed in the form of QR codes, which you can scan in the future for all your transactions. Now, do you need a paper wallet? It really depends on you. And it will also depends on your circumstances. So if you plan to spend the summer, say, if you want to spend the summer day trading a few coins, perhaps you don't. But if you are in for the long haul and don't intend to touch any portion of your stash, then a paper wallet is the most secure option available to you. The paper wallets that you can use are as follows. You have for Bitcoin, Litecoin, and Dogecoin, etc. You can use Wallet Generator. For Ethereum and ERC20 tokens, you can use my Ethereum wallet, and those are on the internet. Just go on the internet, just go on Google and just type in Wallet Generator and my Ethereum wallet. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section. In the last section of today's Sweetie Kiwi Show, we are talking today about how to invest in cryptocurrencies. I'm giving you the ultimate beginner's guide to understand everything you're getting yourself into. And the last thing I want to talk about is the taxes. Please understand taxes related to investment in cryptocurrencies. One thing I want to say though, we're not a tax bureau nor a tax consultant. So if you have issues with taxes and if large sums are at stake, please ask your local tax consultant. Same applies for investment. We're not investors, we're not investment advisors. So we are just providing an educational piece here. Talking about taxes, you have to understand that you want to be careful about where you live. You want to be careful about the fiscal regulations around where you live. And you want to, it's always better to err on the side of caution, on the side of compliance. So if you earn money by investing in cryptocurrencies, you'll likely have to pay taxes, like it is with everything else. Now, how you need to tax cryptocurrency investment returns is up to your national tax jurisdiction. We have an entire show that is covering the taxes issues around fiscal issues around cryptocurrency, so I'm not going to go deeply here. But one thing you have to understand is that in the United States, you have to pay, the IRS has said before, you have to pay taxes on cryptocurrency gains. In Europe and in some parts of Asia, especially Japan, you have micro tax havens. In Europe, for example, Germany and Netherlands are considered, as of the date of this show in 2020, late 2020, those two countries are considered tax havens for cryptocurrencies because they treat cryptocurrency like a property, not a financial product. If you hold your crypto for more than a year, you don't need to pay taxes at all. You don't pay a fiat tax for financial income, but rather the tax on profits from buying and selling. One problem the 1 year rule poses that you need to prove that you hold a crypto for this time frame. So usually exchanges can help you with prints of your trade history. Also, you can use the public blockchain as proof of storage. So in most cryptocurrencies, it is transparent when coins are received and spent by a particular address. So that's kind of really important. So to kind of wrap up the show here and wrap up this session about taxes, you need to just consult with a local tax consultant, local tax advisor. All right, folks, this is it for today. I really appreciate your attention here. I was talking to you about how to invest in cryptocurrencies. I talked to you about learning how to invest in cryptocurrencies, to be okay with taking calculated risks, to remember that there are other coins beside Bitcoin, to think about the utility that the coin is bringing into the ecosystem, to look out for obvious signs of scam, to buy cryptocurrencies properly on the kind of exchanges that you need, learn how to store crypto, and understand taxes related to investments in cryptocurrencies. I will speak to you another time. But until then, remember, stay marvelous.